So in this category, we will not be including it at any point of time. An active market is a market in which the following conditions exist. We are going to find out the value of the asset, measuring the recoverable amount. How are you going to measure it? Good morning and welcome to the session 7 in Unit 3 in International Financial Reporting Standards, where we are going to talk about a very important topic named as the impairment of assets. Now, let's go further and try to understand the meaning of this first. The objective of this standard is to prescribe the procedures that an entity, that is an organization, applies to ensure that its assets are carried no more than their recoverable amount. That is a very, very important point that we need to understand. Now, when you have an asset, you can probably carry forward the asset to a certain limit. But to what limit? Unless and until you are able to get back the recoverable amount. If the asset value is not behind the recoverable amount, then there is no point in accounting for it because the asset will start losing its value. Now, let's say that you have a plant or machinery where you are carrying forward it as an asset. You want to show it in your balance sheet. But over the period of time, with the depreciation coming into picture, the value of the asset will keep on coming down. So beyond a point, the asset will not have any more value as in the financial value. So at that point, there is no way that you can again include it or again carry forward it saying that my plant and machinery is worth so much. So that is why the standard clearly mentions that you will not be able to carry forward the asset beyond the recoverable amount. Second thing is that an asset is carried more than its recoverable amount only if the carrying amount exceeds the amount to be recovered through the use or sale of the asset. Now, when can we do this? Is there an exception there? Now, let us understand that suppose if you are carrying it forward and the amount of value that can be got by the sale is more than the recoverable amount altogether. If I can make through a sale and I can get a value higher than the recoverable amount altogether, then automatically, yes, it can be carried forward. If in this case, the asset is described as impaired asset, and the standard requires that entity to recognize the impairment loss. If this be the case, then we call it as the impaired asset, and the organization has to go ahead and recognize the impairment, which means the organization has to make a mark saying that this is the loss and this is how we are recognizing it. Now, moving further, the scope of this standard. The standard shall be applied in accounting for the impairment of assets other than inventories, assets arising from construction contracts, deferred tax asset, assets arising from employee benefits. Financial assets are within the scope of AS 39, that is financial instruments, and the recognition and measurement. Now let's try to understand. The standard says that other than inventory assets, deferred tax, or the assets from the employee benefit, these factors will not be considered when you are talking about the impaired assets. These categories will not be accounted for when we are talking about. Why? Because they have their separate Indian accounting standards where we are going to count for it, where we are going to measure it and write it down. So in this category, we will not be including it at any point of time. Followed by the following terms are also used in terms of defining the entire concept. The first thing is that an active market is a market in which the following conditions exist. Now, how do you define an active market? Let's first try to understand this. Why? Because the word active market is very, very important here. Active market means where the trade is in a movement. The trade is being carried forward. There is an active trading going on. So that's why I say the items traded within the market are homogeneous, which means they are of the same type and there is a trading going on. Second thing, willing buyers and sellers can be found anytime. So at any given point of time, you will be able to find buyers and sellers for that kind of asset. So that is why this is the second condition coming here. Prices are available to public. So everybody knows the value of the asset. So if you look into the three conditions, it's quite interesting for us to know why, because we are talking about a homogeneous market, a market which has similar exact kind of products, only one kind of products, and there are buyers and sellers at any given point of time, which is not true in a realistic market altogether, and the prices are available to the public. That is also a challenge. Why? Because these days, though there is Google, though there are information hubs for us, but every time we might not know the exact price of the asset. But we believe here that the price is applicable and available for the public. Now, moving further. Now, identifying an asset that might be impaired. An entity shall assess at the end of each reporting period whether there is any indication of the asset to be impaired. So now what I'm going to try to do here is that an entity will now try to assess at the end of each reporting period. So probably at the end of the year, what we are going to do here is that we are going to find out the value of the asset. And if there is any asset of that nature, the impaired asset of that nature, we are going to make a note of this. And if there is such indication exists, 90% of the time you will not get an impaired asset in any of the organization. But if you believe that yes, there has been something like that, then we try to estimate the recoverable amount from that asset. So what is the recoverable amount from that asset? That is very, very important for us. Why? Because we cannot just leave that impaired asset and leave it to a loss. We need to know how much amount we can recover from the asset, and then we will make the entity. Now, the next thing is that measuring the recoverable amount. How are you going to measure it? The standard defines recoverable amount as higher than the asset value or the cash generating unit's fair value less cost to sell its value in use. Now, very, very important here. Why? Because if I want to know the value of the asset, I want to know in such a manner that the recoverable amount is as higher than that of the asset value or the cash that is generated. If you see that if the recoverable amount is less than that generating value or the asset value itself, then there is no point in going for the accounting at that given point of time. So what we tend to do here is that we tend to understand that the unit's fair value in terms of generating cash, in terms of generating that value, has to be first understood. Is it going to generate value lifelong? Is it going to generate value only for that particular use? All those factors have to be understood clearly here. Based on that only, we will be getting in terms of generating the value, generating the use factor altogether. It is not always that we need to determine both as assets fair value. Now, we make an exception here always, saying that because less than the cost to sell its value in use. Now, there might be some time we need to understand after subtracting all the cost, after subtracting all the expenses that we have made use, we need to see what is the value in use. And if either of these amounts exceed, that is either the recoverable amount exceeds, or when we go for the standard method exceeds the assets carrying amount, then the asset is not impaired. At that point of time, I would not say that the asset is gone completely and it is not necessary to estimate the amount. I can still carry it forward. That means it has not come to a position where the asset can be completely written off or said it is impaired. We still have some value left, so I don't have to measure the amount at that point of time. I can carry it forward. Fair value less cost to the sell. Now, using the fair value, subtract all the cost to the sell, then you will get the actual value. Now, why is this? The best evidence of an asset's fair value less cost to the sell is a price in a binding sale agreement in arm's length transaction, adjusted for incremental cost that would be directly attributable to the disposal of the asset. Just look at the factors that we are talking about here. We mean to say that at any given point of time, the best evidence of a fair value is possible only when the asset is going to be sold at an immediate level. Subtracting all the expenses, we can immediately arrive at the true value of the asset. Now, this transaction is something that has to happen immediately at an arm's length, and that's where adjusted to incremental cost would be a direct attribution to the disposal of the asset. So if there is any incremental cost increase or something, that will again go towards the disposable value of the asset. Now, the value in use, this is very, very important. Why? Because when we are using the asset, we are using that value of the asset and it is still in action. So how are we going to do that? The following elements shall be reflected in the calculation of the asset. First one is that an estimate of the future cash flows of the entity is expected. Now, that is going to happen, followed by the expectations about the possible variation in time, amount or timing of those future cash flows, the time value of the money represented by the current market risk-free rate of interest. Now, these are the factors that you need to understand here. An estimate of future flow of cash flow of the money that entity expects to derive from the asset. So what is the future value of the cash flow that we are going to get from the asset? What are all the expectations about the possible variations, either in the form of amount or those timing in form of the cash flows? The time value of the money, which is represented by the current market, and the risk-free rate of interest. So whatever is the risk-free rate of interest, all those factors are also to be calculated here. Followed by which the price for the bearing of uncertainty inherent. Suppose there might be any untoward incident. Suppose there might be a situation where we have not calculated that these factors might affect the asset. That price also we need to take into account. Then other factors like illiquidity. Suppose we are not able to liquidate the asset, that the market participants would reflect in pricing the future cash flow. The entity is expected to derive from the asset. So entity is also expected to derive from the asset in terms of what are all the factors which we are going to look into. So if you look here, we have been trying to understand the value of the asset, not just because it is there, it has been just bought in and kept in place. It is because the value is in use. So tomorrow, whatever happens to the asset, we need to subtract all the expenses, we need to subtract all the factors that are impacting the asset, and then come to know the true value of the asset. With this, I come to the end of this session. I hope and believe that this session was of a great use and of a resource to you. In the upcoming sessions, we are going to talk about the different factors of the accounting standards. We are going to look into employee benefits. We are going to look into the income and other liabilities factor. So all these things will form a very, very important component of the IFRS accounting standards. But until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this wonderful session.